Very good day, my dear students. In this video, we are going to discuss the examiner's comments on the performance of the examinees, which the ICAI has very recently released in respect of CA Intermediate May-23 examination. You will ask, sir, why such a delay? Because it's been quite a number of months since the May-23 exam got over. So there is generally a delay by the ICAI in releasing such document because of the reason that ICAI takes its time in compiling and collating the comments given and submitted by various examiners. So sorry. So this process basically takes some time, and recently the document has been released for the May-23 examination. Now, examiner comments by nature are very important. So different students make different kind of mistakes, errors and omissions while solving the question paper, but it's not everything that is compiled in this document which the ICAI releases, but the top mistakes, errors and omissions committed by the students. And since they have these mistakes have been made by most of the students, they find place in this document, and therefore it becomes very important for us to make a note of these errors and to understand why these omissions, errors and mistakes were made, what should be the right position, and therefore we need to ensure that when we give our exam in the upcoming attempt, we don't repeat and make these mistakes. So if you're using the TaxBook plus practice, one very useful feature in that book is that I have given these examiner comments for various past papers at all the relevant places, and you will find this in gray. Okay, so for example, if this is the chapter on computation of total income and tax liability questions, okay, which you will find in the TaxBook plus practice. So here I have given these examiner comments, and you will find these in gray. So you will see something like this: mistake by students. Okay, and then you will see these comments, and this is something that you will find across the practice book. So this particular feature is something of utmost use to you, and you should make note of all these mistakes by students, pointers which are given across the practice book, because these reflect the most commonly made mistakes, the top mistakes, errors and omissions which students have made in the past, and you must ensure that you understand these and you do not repeat these mistakes when you give your paper. So first we move to section A, income tax law, and then we will move to section B on GST law. So income tax law, we move to question 1, and we will see, so there are basically 3 comments which are given by the ICAI, and we will look at each of these 3. So question 1 is as you know, the first question is the long question on or the comprehensive question, and the first point is with regard to the remuneration paid to Mrs. Beena, wife of Mr. Basin, a proprietor, which is supposed to be clubbed. And we'll see what went wrong. So this question is for CA 2023 May, and Mr. Basin is a resident individual and he provides consultancy services. And the question provides his income and expenditure account. And there is an expenditure which has been booked, employees remuneration of 15 lakh rupees. Okay. And there is an adjustment which has been given as number 1, employees remuneration includes a sum of rupees 3 lakh paid to his wife. So Mr. Basin, who is the proprietor, has paid rupees 3 lakh as remuneration to his wife, who is working as a manager in his office. She does not have any technical or professional qualification or experience required for the job. So technical or professional qualification or experience is missing. And then it is given that the payment of salary was as per market rates in comparison to similar work profile. So what should be done here? So employee's remuneration includes a sum. So remuneration has been paid by Mr. Basin to Mrs. Beena, his wife, and she doesn't have any technical or professional qualification. So what needs to be done is salary or the remuneration to wife needs to be clubbed under section 64(1)(2)(I), and 3 lakh is the amount, and we need to deduct the amount of standard deduction of rupees 50,000. Okay, and the standard deduction will need to be deducted whether we are making computation under the default tax regime, that means under section 115 BAC, or under the optional tax regime. Okay, the standard deduction needs to be deducted, and 2,50,000 needs to be clubbed in the hands of Mr. Basin. Why? Because she does not possess technical or professional knowledge and experience for the job. Now the question is whether the entire 3 lakh should be clubbed or whether 2,50,000 should be clubbed after giving a standard deduction of 50,000. Now what is the mistake that has been pointed out? Omission to provide standard deduction of 50,000 from the remuneration paid to Mrs. Beena, wife of Mr. Basino, proprietor, which is clubbed. Okay, so students fail to provide a standard deduction of rupees 50,000. So the question is whether a standard deduction needs to be provided. And this is the clubbing of income chapter of TaxBook Plus, and this is section 64(1)(2)(I), income from spouse from concern in which individual has substantial interest. So clubbing will happen, and it is specifically given as a tax trap in TaxBook Plus that where salary income is to be clubbed under this provision, it should be computed under the head salaries and then clubbed. Thus, amount to be clubbed should be arrived at after allowing standard deduction under section 16IA. Therefore, standard deduction should be provided, and the mistake that students committed was failure to provide a standard deduction of 50,000. There is number one. Now, since this is an expenditure of Mr. Basin, the question is whether it needs to be allowed as an expenditure or whether it needs to be disallowed. Okay. So the correct response would be that remuneration to wife will not be disallowed as it is as per market rates. Now you could think that disallowance will be made under section 40A2. Why? Because wife is a related party, and a payment to related parties are disallowed under section 40A2. And this is what many students did. What students did is, moreover, remuneration paid to her was also wrongly disallowed while determining PGBP income, though such remuneration was as per market rates. So the mistake that students committed was they wrongly disallowed the remuneration, thinking that the payment is made to wife who is a related party, and therefore section 40A2 disallowance will be attracted. But the mistake was in the incorrect reading of the provision. So if you look at PGBP chapter of TaxBook Plus, section 40A2, to attract 40A2 disallowance, two conditions need to be satisfied. One, the assessee incurs any expenditure in respect of which payment has been made to a related party. Wife is a related party. But this is not the only condition. Second condition also needs to be satisfied. The AO is of the opinion that such expenditure is excessive or unreasonable. But in our case, the expenditure was at market rates. So this condition B was not satisfied, and therefore disallowance should not have been made. But students disallowed, wrongly disallowed. So this was the mistake. So what you need to keep in mind is you should not check only the point of related party, but you should also check whether the payment is excessive or unreasonable. If both the conditions are satisfied of 40A2, only then you should make the disallowance, otherwise not. Secondly, as we noted, if you are clubbing the remuneration, okay, of a related party with the SSE, then under the head salaries, you need to compute the income after giving standard deduction, and then that amount net of standard deduction needs to be clubbed. Second point, the second mistake was with regard to interest on capital borrowed attributable to business. So what is the point here? So if you look at the question, the expenditure side includes interest expenses of 80,000. interest expenses of 80,000. And this is in respect of a house property. Now in respect of the house property, it's mentioned that Mr. Basheen owns a big house with 2 independent units. Unit 1 has been let out for residential purposes. So the income will be taxable under the head income from house property. Okay, Unit 1. What about Unit 2? Unit 2 is the balance 50% of the floor area and it is used by Mr. Basheen as his residence cum office. Okay, so Unit 2, that means half of the property is used as residence cum office, and here since the area of residence and area of office is not given, we need to assume half. So basically 50% of 50% is for office, 25%. So 1/4 use is for office. And if the house property is used as office, then the income will be considered not under the head income from house property, but under the head PGBP. And therefore the interest will be allowed as a deduction in computing PGBP income. Right? And interest was, as we noted above, interest was 80,000. And we saw that interest for the 1/4 portion. So 1/4 portion we assumed is used for office. So 1/4 of 80,000 becomes 20,000. So 20,000 of interest will be allowed as a deduction under the head PGBP while computing business income. Now number 4 says, point number 4, interest expenses of 80,000 represent interest on capital borrowed for the construction of the house, which we saw will be allowed as deduction under PGBP. But it is further mentioned that neither the loan nor interest was paid till the due date of filing the return of income. So which provision will apply here? Section 43B. 43B will apply here. 43B. Because 43B covers interest on loan taken from a nationalized bank. And it will not be allowed in the year in which it is payable if it is not paid till the due date of filing the return of income for that previous year. So under 43B, 20,000 will need to be disallowed. So if we look at the solution, as far as interest is concerned, balance 20,000 is deductible under section 36(1)(3)(I), which is the deduction on account of interest under the head PGBP, but is disallowed under section 43B as it is not paid till the date of filing, due date of filing ROI, return of income. So what is the mistake that the students made? Interest on capital borrowed for house property attributable to business portion, that means 20,000, was wrongly allowed as deduction. It should have been disallowed, though such interest was not paid on or before the due date of filing return of income. So whenever there is a question as regard whether you should allow or disallow deduction on account of interest on loan taken from a bank, you should check 43B compliance. Last point is with regard to computing tax payable. Okay. While computing tax payable, amount of TDS under 194B on winnings from lottery not deducted from the amount of tax liability. So if we look at the question, and this is an important point, in the question there is an item on winning from lottery. Okay. And there is an element as regards the TDS under section 194B from lottery. And the question asks us to calculate the total tax payable by Mr. Basheen. Now what we need to notice, there is a difference between tax liability and tax payable. There is a difference between tax liability and tax payable. What should have been the answer? The answer should have been, we compute the tax liability. Okay, we compute the tax on the income. And this is the tax on the income. From that, we should have deducted TDS under section 194B at the rate of 30% on winnings from lottery. And the balance will become tax payable. So tax liability is the tax which has been computed on the income, on the total income. And when we reduce the amount of prepaid taxes, okay, what we get is tax payable. So there is a difference between tax liability and tax payable. And this is what the students made as a mistake. While computing tax payable, amount of TDS was not deducted from tax liability. In tax book plus concepts, this has been clearly mentioned. Para 208 computation of tax liability. If you see the chart, okay, you arrive at the tax on total income and you add surcharge, HEC, etc., add interest, and what you get is the tax liability. Tax liability means the liability. What is the amount that the SSE is required to pay as tax? That is the liability. But is this amount the actual amount which the SSE now needs to pay? No. It may or may not be. Because if the SSE has already prepaid certain taxes, for example, TDS, TCS or advance tax, that need not be paid again. It will need to be deducted and the balance will be tax payable or refundable as the case may be. So tax liability is not the same as tax payable or refundable. You should carefully check what is the question asking. If the question is asking you to compute tax liability, there is no need to make adjustment on account of prepaid taxes. But if the question is asking you to compute tax payable or refundable, you need to first figure out the tax liability and then make adjustments on account of TDS, TCS or advance tax, that is prepaid taxes. This is the mistake which a student committed. And consequently, the computation of total income and tax payable was incorrect on account of these three mistakes. The next one is on question 2B. And this question was in relation to TDS under section 194R, where there was this point with regard to social influencer. And the comment is that examinees depicted lack of knowledge of newly inserted TDS provisions under section 194. I'm not going to cover this because in the newly notified syllabus applicable from May 24 and onwards, the scope of section 194 has been significantly curtailed. Now the syllabus, if you note the ICAI study material, it now only covers the basic construct of 194R. The question was with regard to a point which was clarified by a circular issued in respect to section 194R. Now all those points are not relevant as far as the new syllabus is concerned, and therefore this question and this particular examiner comment is also irrelevant as at this point of time, so I'm not going to deal with it. Next is on question number 3A. In this case, the students were supposed to compute deduction under section 10AA, and the mistake that they committed was they wrongly provided deduction on under section 10AA at 100% of eligible profits instead of 50%. And some others were not able to compute adjusted total income and AMT correctly. So what was the question? CA 23 May, Mr. Bhagat. He had set up a unit in special economic zone. Section 10AA was applicable, and then there is a mention of section 35AD as well. Okay. And certain details are given, and then the question asked the students to compute the income tax, including AMT under section 115 GSE and AMT credit, if any, under section 115 JEE, payable by Mr. Bhagat for AY 24-25. The deduction under section 10AA under the default tax regime would not be applicable because under section 10AA it is blocked under default tax regime. But while making computation under the optional tax regime, students were supposed to provide for deduction under section 10AA. And the deduction was supposed to be provided at 50% of eligible profits, but the mistake that students committed was to provide it at 100%. Now if we look at the provisions of section 10AA, section 10AA, it is very clear that in the first 5 years from the year in which the unit begins manufacture, production or provision of services, the deduction is to the tune of 100% of eligible profits, that is profits derived from export. Next 5 years it is 50%. Okay. Now we need to figure out what is the year in question. So here we are talking about AY 24-25, that means previous year 2023-24. And the production began in FY 18-19. So 23-24 is which year? 2018, 18, 19, 20, 21, 22, 23. Sixth year. It is the sixth year. So first 5 years, the deduction is to the tune of 100%, but it is 6th year, so it will be to the tune of 50%. So deduction was supposed to be provided at 50%, but the mistake which students committed was to provide it at 100%. And some of the students also computed the adjusted total income and AMT incorrectly. So what we need to note is, whenever we are asked to compute deduction under section 10AA, we need to figure out whether the deduction should be 100% or 50%. Okay. Maybe one of the mistakes that students committed was to begin the computation of number of years not from FY 18-19 but from FY 19-20. If you begin from FY 19-20, previous year 23-24 will be the 5th year. And maybe that's why students gave a deduction of 100%. But what you must note is, when you are counting the number of years, you need to start from the year in which the unit begins to manufacture or produce or provide services, which is FY 18-19 in this case. And this is very clearly given in TaxBook also. From the year in which the unit begins, this is highlighted especially in bold. This was the mistake that students made. They thought that the counting has to begin from the next year, but it should begin from the same year itself in which the manufacture, production or services begin. Next question is question number 4A. And this is in respect of clubbing of income of Neelab, the minor's son, in the hands of his father. So let's take a look at the question and see what is the mistake that students committed. So CA 23 May, and this is the question with regard to Mr. Chaman and his wife Mrs. Chaman, and they have furnished certain information in respect of various incomes. And point number 6 refers to Master Neelab, who is their minor son. He has earned rupees 35,000 from what? From fixed deposit, which was made out of the cash he received on his birthday from his friends and family. And it is provided that Neelab suffers from disability as mentioned under section 80U, and the medical certificate shows a disability of up to 75%. So 35,000 is the income, and Master Neelab is the minor son. He suffers from disability, and disability is mentioned under 80U, and the disability is to the extent of up to 75%. So what should be the treatment? The treatment should be, as far as interest on fixed deposit is concerned, it will not be clubbed. Why? Because son, Master Neelab, suffers from disability specified under section 80U. It will not be clubbed. So it will be treated, it will be taxable under the hands of Master Neelab directly, 35,000. He has no other income as per the details given in the question. So his gross total income will also be 35,000. And he will get a deduction under section 80U because he is suffering from a disability mentioned under section 80U. And since his disability is up to 75%, okay, he will get a deduction of rupees 75,000 under section 80U because it is a case of disability. It is not a case of severe disability. Severe disability is a case where the disability is more than 80%. But in this case, the disability is 40% or more and below 80%, 75%. And therefore, deduction of 75,000 will be given. But we know that deductions under chapter 6A cannot exceed the gross total income. The deduction of 75,000 will only be allowed to the extent of gross total income, which is 35,000, and consequently his total income will become nil. This should have been the correct treatment. Now what did the students do? Examinees wrongly clubbed the income of Neelab minor son in the hands of his father without considering that Master Neelab was suffering from disability up to 75%. Okay. It is clearly given in the book, Income of Minor Child, section 64(1)(a). On the top it is given, where the minor child is suffering from any disability of the nature is specified under section 80U, then income is not to be clubbed with the income of the individual. But students clubbed the income with the hands of his father. That was the mistake. Now, since they committed this mistake, and father, Mr. Chaman, the gross total income would be 35,000 plus 11 lakh 13,500. So they provided full deduction under section 80U of rupees 75,000. And consequently, this figure was wrong. Total income of Mr. Chaman and total income of Master Neelab, this was also wrong. Mistake they did was they wrongly clubbed the income of minor son in the hands of his father. And thereafter they provided full deduction of 75,000 under 80U in the hands of his father. What should have been done is what we discussed some time back. Income of Neelab should have been taxable in his own hands, and then deduction under 80U should have been restricted to the extent of his gross total income, that means 35,000. So whenever we are talking about the clubbing of income of a minor child, we need to check whether the minor child is suffering from a disability under section 80U. If yes, then clubbing will not be attracted. Clubbing will not be attracted. Also, even if the case is not of disability under 80U, but the income is on account of manual work done by the child, or it arises because of skill, talent, specialized knowledge and experience of the child, even then clubbing should not be done. The income will then be taxable directly in the hands of the child. And if it is a case of disability under section 80U, and when you are taxing the income directly in the hands of the child, you should ensure that 80U deduction does not exceed the gross total income. Okay, these are the points that you should keep in mind. Okay, last comment in respect of income tax is on question 4B. And this is in relation to sections 80AA and 80EB. Let's see what was the question. CA 23 May. The question was in respect of Mr. Ray, and these information were given in the question, and then we were asked to compute the amount of deductions available to Mr. Ray under various provisions of Income Tax Act, so that he gets the maximum benefits, assuming that he has opted for default tax regime under section 115 BSE. And if you look at the answer, there will be a deduction allowable in respect of interest on borrowed capital while computing income under the head income from house property. And then there will be deductions allowable under chapter VIA from the gross total income, and they will be under section 80C, 80EA, 80EB and 80GGC. Now the mistake that students committed was with regard to 80EA and 80EB. And what they did was they could not correctly calculate the amount of deduction available under 80EA, 80EB. They had not restricted the deduction under each of these sections to rupees 1,50,000, because this is the limit. This is the limit, 80EA and 80EB. What is the limit of deduction? It is 1,50,000 and 1,50,000. 1,50,000 in both the cases. So if we look at 80EA deduction, based on the information in the question, you will arrive at an amount of 1,65,000. But you should give deduction only to the extent of 1,50,000. But what students did is they gave deduction of full 1,65,000. Similarly, 80EB for interest payable on loan taken from bank for purchase of electric vehicle. If you look at the question, vehicle loan was taken and the amount towards interest was 1,90,000. Students gave deduction of full 1,90,000. Without appreciating that deduction is to be allowed only up to 1,50,000. So these were the mistakes that students made in respect of income tax. Now let's move to GST portion. The first comment is with regard to question 5, and this is the first long comprehensive question on the GST section. And the first comment in respect of ITC in respect of purchase of business class air tickets for travel from Assam. And let's see the question. So the question was CA 2023 May with regard to Geno Enterprises. Various details given in the question, and finally it is required to calculate the amount of minimum CGST, SGST and IGST tax payable in cash for the month of October 23. So we are talking about October 23. Okay. And therefore we need to compute the minimum GST payable, and for that we also need to figure out the amount of ITC available, so statement of ITC that can be availed. Now one of the points was point number 4, purchased business class air tickets for intra-state travel from Guwahati Airport, Assam to Dibrugarh Airport, Assam for its executive employees related to business of the concern. So travel within Assam in business class air ticket. And basic airfare was 40,000 and airlines charges GST in case the same is applicable. So what should be the correct position? So it is a case of business class air tickets for travel within Assam. Now the question is this exempt or is this taxable? So if we look at the exemptions, transportation passengers, what is exempt? Entry number 15, by air in economy class embarking from or terminating in an airport located in the state of Assam. So here the travel is within Assam, but the travel is not in economy class, it's in business class, so it will not be exempt, it will be taxable. Since it will be taxable, ITC will be available. ITC will be available. So in the statement of ITC, GST on intra-state air travel not exempt as not in economy class, though travel is within Assam, and therefore ITC should have been availed. But what did the students do? Most of the examinees were unaware that purchase of business class air tickets for travel from Assam is not exempt taxable, since air travel embarking from Assam is not being undertaken in economy class. Resultantly, they did not avail ITC for the same. So you need to be clear that it's not only the state which you need to check, you also need to check what is the class. If it is economy class and if the state is as that listed in the exemption entry, then only GST will be exempt. If not, then GST will not be exempt and consequently you can avail ITC. Next point was regarding wrong consideration of invoices relating to FY 21-22. So here it should be 22-23 because now in the practice book we have updated the question by adding one more year to make it suitable for the current edition. So let's look at the question. So in the question, one of the points was point number B. In respect of few of the invoices relating to FY 22-23, and the question is with relation to October 23. So FY 22-23 is the year preceding the current year. So in respect of few of the invoices relating to FY 22-23, ITC of CGST 20,000, SGST 20,000 and IGST 80,000 was not taken earlier. So it was not taken earlier. And now Geno Enterprises wants to avail credit in respect of such invoices in the current month, that is October 2023. So what is the position? We need to figure out whether the ITC in relation to invoices of the preceding year can be taken in the current year in the month of October 2023. And for that, what are the provisions which are relevant? Section 16(4), time limit to avail ITC. And we know that the time limit is the earlier of the following: 30th November following the end of financial year to which invoice or debit note pertains. So FY 22-23, 30th November following the end of FY. That means 30th November 2023. Or furnishing of relevant annual return, whichever is earlier. So as per this provision, what should have been done? As per this provision, since we are talking about October 2023 and 30th November 2023 is not yet over, we could have said that invoices related to FY 22-23, ITC can be claimed till the earlier of A, 30th November 2023, or B, furnishing of a relevant annual return. And since no information has been given in the question, it is assumed that it has not been filed yet, and therefore the time limit is not over, and consequently these amounts can be claimed as ITC in the current month. What is the mistake that students did? Majority of them wrongly considered invoices relating to FY 22-23 as opening balances of ITC. Instead of availing the ITC like this, they said that it is opening balance, and they added the same amount here, here, and here. So the aggregate will remain the same. It will not change. But the approach was incorrect, therefore the students lost marks. So the comment says that they were ignorant of the provision that ITC in respect of any invoice can be taken up to 30th November following the end of FY or the relevant annual return, furnishing of the relevant annual return, whichever is earlier. So they were ignorant, and instead of separately availing the ITC, they actually presented it as the opening balance, and consequently they lost marks on this count because the approach and the presentation was not correct. So what we need to note here is that if our presentation and the approach is incorrect, but coincidentally the final answer is correct, then we cannot claim marks. The marks will be lost because the way in which we solved the question was incorrect. And therefore the presentation, the approach, the right provision, right, putting all of that together in your answer is very important. Else you cannot argue that since the net or the final answer was correct, I should be given 100% marks. It will not happen. Next question is question 6A, and this is with regard to performance of classical dance. Let's see the question. CA 2023 May, Mr. Jayesh. Certain details are given, and then we are required to compute the gross value of supplies on which GST is to be paid for the month of October 23. One of the items is number 3. Amount received from ABC Limited for performance of classical dance in one program, and the amount received is 1,74,500. What should be the solution? What should be the approach? Amount received for performance of classical dance in one program is not exempt since consideration charged is greater than 1,50,000, and therefore the entire amount received, which is 1,74,000, is taxable and nothing is exempt. Okay, why? Because this is entry 78. Services by an artist by way of performance in classical art form of dance is exempt if the consideration charged is up to 1,50,000, not more than 1,50,000, and it is clearly given in the book, in TaxBook Plus, that if the consideration is more than 1,50,000, entire consideration is taxable, not the excess, and this is exactly what the students committed as a mistake. What they did is they deducted 1,50,000 from 1,74,000 and considered the excess or the difference, that means 24,000, as taxable amount, which was incorrect. So in respect of this particular point, in respect of performance, you need to take into account the fact that if the amount exceeds 1,50,000, then the excess is not taxable, the entire amount is taxable. That means nothing becomes exempt. Next comment is with regard to question 7A, and this is with regard to order of discharge of GST liability under section 49(8). Now let's look at the question. Mr. Manik provides the following information regarding his tax and other liabilities under GST law as per electronic liability register. Tax due for the month of May, interest due for the month of May, penalty due for the month of May, tax due for the month of June, liability arising out of demand notice, this, and he wants to clear his liability of demand notice first. He wants to clear this first before the other liabilities. Discuss the provisions of order of discharge of GST liability. So the answer should have been, every taxable person is required to discharge his tax and other dues in the following order. Self-assessed tax and other dues related to returns of previous tax periods. Self-assessed tax and other dues related to returns of previous tax periods, number 1. After that, self-assessed tax and other dues relating to return of the current tax period. And then finally, any other amount payable, including demand under section 73-74. Hence, Mr. Manik cannot clear his liability under section 73 first. So the order of discharge of liability will be this, and this. So basically, the examiners have commented that while stating the provisions, most of the examinees wrongly mentioned previous year and current year instead of previous tax period and current tax period. Previous year assessment year is a concept in the Income Tax Act. It is not a concept in the GST law. In the provisions, it is clearly mentioned previous tax period, current tax period. And in TaxBook Plus, these have been highlighted in bold. That means these are important. You need to capture these terms in the answer as they are. You cannot change the meaning. You cannot make previous tax period and write it as previous tax year or previous year or the current year, right? Because it is not a matter of year. It is a matter of period relating to the return. Return may not be furnished for the entire year. Return may furnish on a monthly basis. So the period becomes a month. If it is furnished on a quarterly basis, the period becomes a quarter. If you write previous year, you are saying that the return is always for an year. That is clearly incorrect. So income tax law is different from GST law. And that's why you need to use the proper terminology, because there is a logic behind use of a particular terminology in any law, right? So when we are talking about returns, we need to use the word period and not the word year. Next comment, question number 7BI. And this was regarding QRMP scheme and the provisions thereof. Let's look at the question. Mr. Sumit is a registered dealer in the state of Punjab. In the month of May, he decides to apply for QRMP scheme. As he wants to switch to QRMP scheme, he had not filed his returns for the months of May and June. Please guide regarding the following. A. Conditions and restrictions of QRMP scheme and manner of exercising option of QRMP scheme. Okay. So 2 points here in respect of which there are examiner comments and where the students committed a mistake. So while giving the answer regarding the eligibility of QRM scheme, it should have been mentioned that a registered person is eligible for the scheme if he has aggregate turnover of up to 5 crore in the preceding financial year and he has opted to furnish a return for every quarter. Okay, so first, the correct statement in respect of the first condition should have been he has aggregate turnover of up to rupees 5 crore in the preceding financial year. But what did students mention? In a large number of cases, students simply stated that turnover should be up to 5 crore. But this is incomplete and this is also misleading and incorrect. The complete correct statement should have been that aggregate annual turnover is up to 5 crore in the preceding financial year. So again, you need to be well versed with the provisions. You cannot simply give an incomplete provision by ignoring or skipping some of the terms or words and then expect marks to be allotted to you. No. Because tax is to be constituted strictly. If you are not specific, if you are not complete, if you are not clear enough, the meaning can change, the meaning can become misleading, and you will lose out on marks. Examiner will not give you the marks. Simply saying that turnover should be up to 5 crore. Okay. Which turnover? Aggregate turnover, ATO. There is a specific meaning to the term ATO. And when? In the preceding financial year should also be mentioned. So if you mention incomplete provisions, how can you expect marks to be given to you? Okay. The second point was regarding exercise of this option. So it is clearly given in the book that option for QRMP scheme once exercised need not be exercised every quarter. It needs to be exercised only once. Where such option has been exercised once, the registered person shall continue to furnish GSTR 3B on a quarterly basis for future tax periods. This is what the students did not mention. So what is the comment? They were also unaware that this option is not required to be exercised every quarter. So probably some of them mentioned that this needs to be exercised every quarter, or some of them did not mention this point at all. So when we are asked in the question about the provisions, about the conditions and restrictions, and then B, specifically manner of exercising option of QRMP scheme, We need to clearly mention the provisions of law. Last comment with respect to GST was in respect of question number 8AI regarding composition scheme for goods. What was the question? The question was, who are not eligible to opt for composition scheme for goods under the GST law? Okay. And one of the points was, okay, if you look at the tax book, contours of composition scheme, eligibility conditions under the scheme. A registered person is eligible to opt to pay tax under composition scheme if he satisfied the following conditions, and this is composition scheme for goods and composition scheme for services, and the question was with regard to composition scheme for goods, and the answer should be that these 1 to 7 are the conditions. So if these 1 to 7, if any of the 1 to 7 condition is not met, then the person is not eligible for composition scheme for goods. And one of the condition was number 5. He is not a manufacturer of notified goods. Notified goods, all these 1 to 8, ice cream, pan masala, aerated water, so on and so forth. So he is not a manufacturer of notified goods. And it is clearly given in TaxBook Plus that trading of notified goods is not restricted in condition number 5. What is restricted is manufacture. So he may be a trader or a dealer of notified goods. He will still be eligible. But if he is a manufacturer of notified goods, he will not be eligible. So this should have been mentioned. And what is the mistake that students made? Instead of correctly mentioning that the manufacturer of notified goods is not eligible, some examinees wrongly answered that trader or dealer of notified goods is not eligible and hence lost marks. So you need to be clear, and that's why in TaxBook Plus I have given these tax traps specifically which are in gray. There are hundreds of tax traps spread across TaxBook Plus, and the whole objective of these tax traps is to make sure that you don't avoid these commonly made mistakes. See, it is very clearly given, and this is a tax trap. And if you don't follow the tax traps and if you don't note them carefully, there are high chances that you will make one or the other commonly made mistake in the exam, and therefore you will lose marks. So this was the discussion on income tax and GST. Hope you will consider these points seriously and with full sincerity, and ensure that you don't commit these mistakes and repeat those mistakes when you give the paper in the upcoming attempt. And here 2 very important things that you need to keep in mind while studying from TaxBook Plus. If you are doing so, 1, very carefully scan and check all the examiner comments which are given across TaxBook Plus practice. So as I told you before also, these are given in gray italics, and you will find something like this, mistake by students, and then you will have these examiner comments across various chapters, across the practice book. You will find these, so very carefully go through these. Second, go through all the tax traps given in TaxBook Plus, and this you will find in the concepts book. For example, this is the concept book, so you will find these in gray. You will find these in gray across various chapters across the book. These reflect the caution areas. I have highlighted the caution areas which are the commonly made mistakes. So you need to very carefully go through tax traps and examiner comments. These will greatly help you to avoid making the same mistakes which students have been making on and off in the past. So this brings me to the end of this video, and I have a couple of requests to make to you. If you have not yet subscribed to my channel, please do subscribe and hit the bell icon, especially because it will ensure that you do not miss out on any video which I upload. Secondly, my humble request to you will be to please like this video as much as possible, because when you like, YouTube relays this video to many other students who may be in need of this video, right? And lastly, write your comments in the comments box. If you have any doubt or clarification, feel absolutely free to reach out to me anytime, and I'll be more than happy to help you out with. So with this, I conclude this video. All the best to you. See you very soon in my next video. All the best. Good luck. Goodbye.